Welcome to Think Change. I'm Sara Pantuliano. Global finance has shown notable resilience despite the currently high level of global economic uncertainty, the geopolitical tensions, and the adverse debt dynamics. We're seeing capital flows and investment remain more important than ever, particularly for emerging and so-called developing economies. And strikingly, assets held by non-bank financial institutions have increased significantly. They've reached $250 trillion. That's approximately 400% of GDP in advanced economies. And yet, despite the growth and importance of capital flow dynamics, particularly for productivity and for economic growth, real investment as a share of GDP across multiple emerging and advanced economies has largely stagnated or, in fact, declined since the great financial crisis of 2008. We're seeing persistent frictions, market coordination failures, and mispriced risk that continue, in part, to impede capital mobilization for the purpose of growth. So getting this right and bridging this gap to support investment and productivity is critically important for sustainable development. So today we're asking, if capital is abundant, why isn't productive investment keeping pace? And what role can the G20 play in shaping a more resilient and sustainable capital flows framework in a fragmented global economy? I'm delighted to be joined by three leading experts for this important conversation. With me, I have Marcelo Carvalho, former Global Chief Economist at BNP Paribas. I'm Ali Cakiroglou, Director of Emerging Markets Research at HSBC, and our very own Phyllis Papadavid, Senior Research Fellows at ODI Global. Thank you all for joining us. Marcelo, let me start with you. The G20's core mandate is macro coordination, but we're really in a period of fragmentation and geopolitical rivalry. So is meaningful coordination on forex alignment, on regulation, on digital currency interoperability realistic, or are we now past that era?
Sarah, when we think about macro coordination, we have to think no longer in terms of an orchestra, but we have to think in terms of a jazz band. So let me explain. Listen, for many decades after World War II, especially after the Cold War, we had the US-led global order, right? Based on rules of engagement, based on cooperation, on values, based on multilateral institutions like the UN, WTO, Bretton Woods. These days are over. The old order has died, but a new one has yet to be born. So we now live in a much more fragmented global environment, an environment with spheres of influence, an environment with variable geometry. And in this new environment, critically, the role of the US has changed dramatically, right? The US is now following a more transactional approach, focused on short-term gains and narrow interests. It's no longer, fortunately, it's no longer seen by others as a reliable partner and doesn't seem to be interested anymore in leading the global cooperation. So coming back to my analogy, the US is no longer the conductor of the orchestra. So what we have now seems more like a jazz band. I mean, we have more improvisation. It sounds messier. It's less predictable. And you have more bilateral conversation between the players, between the instruments. So if before we had one single clear conductor of the orchestra, now have many players taking turns in leading the band. So, I mean, don't get me wrong, Sara. I love jazz, right? It can sound great. But just don't expect it to sound like an orchestra anymore. You mentioned here geopolitics. I think geopolitics is the new key global macro driver. If you think about currency blocks, if you think about trade agreements, payment systems, regulation, I think security alliances, geopolitics have now become the key driver.
Yeah, I think you make a very important point there. I mean, Ali, we are seeing extraordinary growth in non-bank financial assets, as I said, about $150 trillion. And yet foreign direct investment into emerging markets has been declining. So from where you sit in the market, is this a pricing issue? Is this a risk perception issue? Or does there need to be a structural shift in how global investors allocate capital?
I mean, I wouldn't necessarily put this as a pricing issue because we are also continue to see, some markets, some emerging markets continue to attract capital. But I think if you look at the developments over the last 2.5 decades, there are some, changes, and these are mainly, most of the drivers for this shift in terms of the foreign direct investments. Because during the 2000s, it was more about the pull factors, meaning that money was pulling out from developed markets into emerging markets, and all the main drivers for that was the strong economic activity, which was led by total factor productivity growth, as you rightly suggested. But on top of that, we were also seeing that EM's growth differential with the developed world remaining high. And as a result of that, the return on investments were quite, sizable for emerging markets. Then we had the global financial crisis, which led to huge liquidity, increase globally because of the quantitative easing by developed world central banks. And on top of that, the yields have declined to zero, if not negative, among the major economies. And in this environment, money was more inflows into emerging markets were more about to do with the sort of yield seeking, and it was led by portfolio flows rather than the foreign direct investments. So basically, the 2000s were the episode where strong growth was leading to sort of strong productivity and higher return on investments, which also led to foreign direct investment flows. And 2010s, after the global financial crisis, it was more about the sort of the yield-seeking investors putting money into emerging markets in terms of the portfolio flows. So I think now maybe emerging markets are at a crossroads, but what would matter most in this environment is whether emerging markets could actually revive their economic activity, a productivity-led growth that could also increase the return on investments and, as a result, longer-term capital flows.
Thanks, Ali. Phyllis, at ODI Global, we focus on foreign exchange misalignment as a barrier to capital mobilization. How significant is FX risk in deterring this long-term investment in emerging markets and so-called developing economies?
Yes, Sara, I think FX risk is significant. Marcelo mentioned that the new world is yet to be born. But what we can say, I think, for some emerging market economies...
I hear Gramsci quoted so much these days, but carry on.
What we can see, though, is that some emerging economies are potentially entering this new era of fragmentation in somewhat of a fragile state. So what's concerning is that when FX risk flares up, it can create uncertainty, which does deter the longer term types of investments into some countries. So we know certain currency policies treated as a proactive tool can support very high growth scenarios, such as what we saw in China, for example. But if a currency is disorderly, or if it's mishandled or misaligned for too long, it can actually arrest economic transformation. It can prevent a rotation into higher value-added growth. And what's a little bit worrying in some countries is that we are seeing, as Ali said, portfolio investments come in, but we're not seeing the types of investments that foster productivity growth. And FX can be a tool for this, but it can also, if it's not sort of used effectively, it can arrest economic transformation, healthy investment, and a whole range of things. And the best case scenario, which, the IMF has pointed out, the BIS has pointed out, is that, when a country has credible macroeconomic, monetary, and fiscal policies, it's everyone says it, everyone sort of repeats this mantra, but the improvements in countries that we've seen are based on credible and committed monetary policy, which bring about a shift in their asset prices to a more stable equilibrium. So that's really what we want to see.
Can I add one comment here?
Yes,
if that's okay. So Phyllis, I think when you think about FX risk, I'm not sure if you agree with me, but I think one key development in emerging markets, which has been very helpful, is the development of local capital markets. because emerging markets worry about the so-called original sin, right? The idea that if you issue too much debt in foreign currencies, if capital flows shrink, you have a problem. It's the so-called problem of a sudden stop, right? I mean, think about it. If you jump from a building, what kills you is not falling. What kills you is the sudden stop. So that's what the emerging markets worry about. However, the development of local capital markets, I think, has been very important in terms of reducing the so-called original sin and therefore reducing or mitigating FX risk. Would you agree?
I do agree. And I think that, post-crisis is one thing where a country receives the liquidity and the support that it needs to emerge from a crisis. But then what happens after that in post-stabilization, the reforms that are enacted in post-stabilization are also very important. And what we've seen in a number of countries, as you mentioned, Marcelo, is that they are engaged in local currency financing, which of course brings its own set of risks, but it has mitigated a whole set of other risks, like the transmission of dollar-related shocks, for example. So I think it is an important step, and we are seeing it actually in a number of emerging and developing economies.
Let's stay on the macro perspective for a second. I mean, I think, Marcelo, it's fair to say that many emerging market and developing economies have shown resilience despite that stress, rising interest burdens and global shocks. But this resilience has not translated into stronger investment. So what do you think is missing? Is it policy credibility, global demand, institutional reform? What is it?
Well, I think, Sara, there are two factors here to consider. I mean, first one is that the current global shock is not that bad for emerging markets, actually. Let's face it. I mean, many things are bad currently, of course. The increase in protectionism, the increase in uncertainty, fragmentation, none of that is good. However, there is one thing which is actually quite positive, in the short term at least, for emerging markets, which is the weaker dollar. I mean, before, whenever you had the global shock, typically you had a run for safe assets, namely US Treasuries, namely appreciation of the dollar. It's no longer the case. I think this is quite different from previous episodes. The dollar is now weakening against everybody else, and therefore everybody else, including emerging market currencies, is strengthened. And that's quite important because a stronger emerging market currency helps to bring inflation down in those economies, therefore allows the central bank to cut rates more than otherwise would be the case, and therefore allows for faster growth, at least in the short term. So that's the first point to make here. It's not that bad, right, what's going on, at least cyclic in the short term. The second point now, however, I would make is that resilience is necessary but not sufficient for long-term development. I mean, it's necessary, of course, and it's quite welcome, the fact that emerging markets are more resilient now than ever before. Their current account deficits are much lower. Their stock of foreign international reserves is much higher. They have more local currency debt, as mentioned before, which is all very positive. However, this is not sufficient. For long-term investment, for really a long-term growth and development, you need to focus on the macro fundamentals. I mean, there is no surprise here, no secrecy. You have to put your fiscal house in order. You have to improve the business environment, have to have a reliable, credible legal framework, simplify the tax system, having a stable macro environment, focus on human capital and infrastructure. So let me use an analogy here. I like metaphors, as you can tell. And it's like, I mean, if you have good sleep habits, if you have a healthy diet, you are more resilient to getting a cold. However, if you want to run a marathon, you have to go to the gym. So resilience is necessary, but not sufficient for long-term growth and development.
Well, let me ask Ali about this because, actually our own work at ODI Global really shows that capital is tilting towards shorter term portfolio flows rather than, foreign direct investment that can really enhance productivity. So Ali, do you agree with Marcelo? I mean, is it that investors are structurally less willing to take long-term risk in emerging markets now because of the condition Marcelo has just described? And if so, what would make them change, invest more sustainably in these economies?
Well, let me start by saying that, when we published our year ahead outlook, we asked the question about whether this is the moment where we are going to see an EM renaissance, because as Marcelo rightly pointed out, the global backdrop is much more supportive for emerging markets. You're seeing relatively decent economic activity. Global liquidity is to some extent improving because Fed is no longer, implementing quantitative tightening. If anything, it's also expanding its balance sheet by through repo auctions. And at the same time, EM's, own dynamics in the sense that, growth inflation mix, as well as the, more credible monetary and fiscal policies are definitely there. But I guess, when we look at the longer term, especially for foreign direct investments, I think it's not only related to these, sort of the cyclical drivers. What investors absolutely want over the longer term is more credible return on investments, right? And especially following the global financial crisis, one of the things that we have seen across all both emerging and developed economies was actually a sharp decline in return on investments, and that was decline in foreign led to a decline in foreign direct investments. And I guess there are a couple of reasons for that, but one thing might be related with the fact that because capital was so abundant, liquidity was so abundant, we have seen some sort of a misallocation of capital across all sectors, across countries, and all these have also led to sort of a decline in return on investments. So going forward, it's pretty much fair to say that the longer term story would be a function of what is going to happen in the return of on investments. Yes, short-term portfolio flows do respond to yields or spreads, but long-term investments in the form of foreign direct investments respond more to sort of multi-year, expectations about capital efficiency, about the return durability, and all these would be a function of, how emerging markets could revive their long-term growth through maybe productivity-led, economic activity. And I think that's the sort of the missing part for very long-term foreign direct investments for the time being.
Thanks, Ari. And maybe there is something going back to what Marcelo was saying about, the orchestra that can be done to try and bring together some of these issues. I mean, Phyllis, the UK will assume the presidency of the G20 in 2027, next year. Can the UK differentiate itself and try to advance a sustainable capital flows agenda beyond previous presidencies to really help with what we're discussing today?
I think it can. I mean, the UK is in particular is in a prime position to promote an innovative agenda for global capital flows. And linking to the point that Ali was saying about credible returns on investment, they are inherently linked to credible growth prospects over the longer term. When a country wants to attract long-term investments, investors look to actual credible growth prospects, and that necessarily links to better productivity outturns. Any country that has been what we call a breakout country and has seen big increases in GDP per capita and has actually broken through what we call the middle income trap, has had to succeed with financial inclusion, with providing access to finance. Malaysia, for example. So the UK, in taking the G20 presidency, is in prime position to foster a new and innovative agenda for access to finance, not just for advanced economies, but for middle income and lower middle income economies as well. And, I think more multilateralism rather than less multilateralism should be the tone that is struck. It's really important, I think, in the agenda, because as Marcelo mentioned quite early on, geopolitical shocks are actually leading to financial fragmentation. and financial fragility. And they are asymmetric and persistent and more longer lasting. Actually, the BIS has done some research recently saying that geopolitics is now as powerful as monetary policy in the decline of cross-border bank lending between countries. So, geopolitics is really important, and that's what makes the G20 a prime place to up the ante, actually, on multilateralism, especially around finance and promoting a coordination amid these shocks that are sort of bubbling up. The thing with shocks and risks is that we might be entering a new era, but there's the old shocks and the new shocks now. So there's a whole multitude of risks and shocks that are shaping the financial landscape. And the UK is a financial powerhouse, so it's in a prime position to lead the agenda.
Let's hope it does. Look, we're coming to time, but I want to put one last question to you all. What lessons can be learned from past crises where financial resilience did not translate into long-term productive growth? Phyllis, I'll start with you.
Yeah, crises are an interesting one. They often say each new crisis arises from a new catalyst. It's never the same catalyst. But I mean, my feeling is that some of the most acute and prolonged crises, such as the one, for example, in Greece, that lasted for almost a decade, at great economic and social cost, could have been mitigated with just a frank and early assessment of fiscal dynamics and just where the imbalances are and where the risks are. And I think more generally, in emerging successfully from crises, we know that the quality of institutions matter for economic growth and for capital mobilization. So consistent and credible policy is crucial in setting, in steering economies away from distortions and imbalances. And we need a sort of strategic complementarity between institutions, I think, at the moment, to protect against the global shocks that are actually driving business cycles. Global shocks are driving business cycles now. It's no longer domestic demand that's driving the business cycle. It's shocks that are driving business cycles. And so I think the quality of institutions in mitigating global shocks is really important.
Ali, do you agree?
I mean, I 100% agree. And I guess, one of the things that is important to note is that, stabilization does not necessarily mean or is the same as transformation, right? Because we have seen that after many crises over the last 2-3 decades, that emerging markets managed to rebuild their reserves, they improve their fiscal positions, and we are seeing, central banks are strengthening their credibility and they're restoring macro stability. But that resilience, even though it's critical, it's not by itself allows or creates this stronger investment or sustained growth backdrop. And markets need, reward stability. They commit to capital where productivity is improving, where the return on investments is improving. And without the structural reforms, I think it's quite difficult for for emerging markets to continue to attract those longer term capitals. And Phyllis rightly mentioned about the institutional credibility. I would add to that, the human capital investment into tertiary education and all these things would most likely, continue to help for longer term sustainable growth in emerging markets and lead to sort of the longer term inflows into emerging markets. And I think apart from that, it's also quite important to note that, macro stability is one thing, but, this longer term structural improvement in capital, return on capital is another thing. And I think, what would matter more over the longer term productive growth would be more related with all these reform agendas in emerging markets.
Marcelo, what's your final take?
My final take is that judging from previous crises, a key message is that good policies are different from good luck, that short-term cyclical tailwinds are different from structural longer-term fundamentals. I mean, look at the early 2000s, as Ali has mentioned before. We had a weaker dollar leading to a commodity price boom. Major market currency, major market economies benefited, right? You had copper in Chile, Peru, gold in South Africa, oil in Colombia, Middle East, or iron ore, soybean in Brazil. So it felt great. But this was good luck, not necessarily good policies. And then we had the global financial crisis 2008 and things turned around. So if short-term capital flows increase into equity, local debt markets, as seems to be happening today, it's great. Emerging market currencies improve. But I think policymakers should take advantage of this cyclical tailwind to do the needed reforms that attract structural long-term foreign direct investment, because that's what's going to lead to long-term sustainable growth. So the key takeaway for me, Sara, is that the best time to fix the rooftop is when the sun is shining.
One thing, if I may just add about, because Marcelo rightly pointed about the 2000s, and actually this was the episode where we have also seen the wave of globalization, which was at its peak, right? And that was also partly related with, China becoming part of the WTO, World Trade Organization, but at the same time, it was more about, again, the questions or investors were more looking about, longer term, potentially higher return on investments, and emerging markets having a much more favorable demographic dynamics, the links about, and the link between, this favorable demographics and consumption was more willing to add capital, invest into those emerging market economies. I think that was also quite an interesting episode. The 2000s were also interesting from that point of view.
Thank you, Marcelo, Ali, and Phyllis. While the early 2000s did feel like a golden era for many emerging markets, a weaker dollar, soaring commodity prices, China's rise, and peak globalization did create extraordinary gains. But as Marcelo reminded us, much of that was good fortune, not necessarily deep reform. And when the global financial crisis hit, that luck ran out. So we may be seeing favorable conditions again today, stronger currencies, capital flowing into local markets, a softer dollar, but we've been here before. Cyclical tailwinds can lift markets quickly, but they cannot on their own deliver lasting prosperity. Short-term capital is not long-term commitment. And as Ali made clear, sustained investment follows credible returns. And credible returns come from higher productivity, from better institutions, from real reform. Phyllis underscored how in a fragmented world, increasingly shaped by geopolitics, policy credibility and international coordination matter more than anything. These discussions tie directly into our weekly macroeconomic briefing series called This Week in Macroeconomics, curated by Phyllis. And in fact, the recent issues towards the G20 framework for capital flows to EMDEs informing the UK presidency did draw on the G20 capital flows workshop that we held recently and explored how collective action and policy frameworks can help turn supportive cycles into sustainable growth. Please check it out in the show notes and do sign up for our weekly insights. So the real test is what governments do when the sun is shining, as Marcelo said. Do they ride the wave or do they fix the roof? Thank you for listening. Until next time.